in Asia and the direction of travel through the day. We've seen through this week, we're now Thursday, November 4th, a week in which oil prices have had a downward trend. We saw last week oil prices closed out the week down for the first time in many weeks, and now we're seeing another downward push. Number of issues to get through today at what is the last day of the Middle East week. Let's kick off with Dr. Carol Knackley, CEO of Crystal Energy, regular Thursday morning commentator. And let's start, Carol, with the decision by the Fed to finally sort of bite on the tapering decision and move forward with that $15 billion a month. The markets rose, the stock markets rose in anticipation that indeed this was a simple taper and not a tantrum. Your thoughts, could this still be a tantrum?
Good morning, Sean. Good morning, everyone. I like the use of tantrum because I have a toddler who is becoming a specialist in throwing tantrums. But when it comes to the Fed, and look, there were no surprises there. And I think that's very important because it's something that the chairman of the Federal Reserve keeps on saying. And he kind of reiterated this again and again this time by saying they are not going to surprise the market. They will go, they will proceed in a very transparent manner. So the market expected the kind of tapering, the speed at which and the pace at which this is going to happen. There is some flexibility, but so far we're expecting that to be completed by June next year, though again, the central bank, the Federal Reserve, told us that this may be adjusted depending on the conditions. The only, I would say, change in the tone or the announcement made was a kind of attitude vis-a-vis inflation, because before there was more certainty, more confidence in the tone when they said that the inflation is transitory. But now we heard a different kind of expression. I don't know if there isn't much to read into it, but they call it expected to be transitory. And I think this is what people picked on that, but they didn't put too much emphasis on it. I would say from the US side, things look to be transparent and we can have confidence in their policy. And they told us that interest rate, they can still be patient before raising interest rate. What worries me more is the kind of uncertainty that we have here in Europe, because while the ECB and Christine Lagarde say that they are not contemplating any rise in interest rates anytime soon, I have the feeling that the market seems to be less confident vis-a-vis the ECB's policy on the monetary policy than they are vis-a-vis the US.
I would be very tempted to bite into some of those things, but we'll hold off for now because clearly the Fed, I mean, I've come to the point where I just don't trust anything they say. It's sort of whatever meets the moment. But let's go to Robin Mills, CEO of Camar Energy, and the other big story of the week. Not that it has immediate relevance to the oil markets per se, the energy markets, but I was struck, Robin, by your column in the national newspaper. We're carrying it on our daily digest today, that indeed COP26 is better than expected. That seems to be counter to the narrative in which it's generally the tone seems to be one of disappointment. Your thoughts?
Yeah, absolutely, Sean. Yeah, so I mean, almost every COP is regarded as a great disappointment. I suppose the big exception was Paris in 2015, which obviously came out with the Paris Agreement. But everyone has these great expectations, and I think activists, of course, and environmentalists have very great ambitions for everyone. And of course, the result usually falls short of that. But I think this year's COP is looking much better than previous ones, and there's been genuine progress on a number of big hot button issues. So that's very promising. And really, so the whole point of this COP is, okay, it's 5 years on, or should have been 5 years on from Paris if it were not for the pandemic. The idea is, okay, every country has to update their Paris goals, but also put flesh on the Paris agreements in terms of real tangible actions. And we've seen those coming out of COP26. The G20 meeting that preceded it was very disappointing, very weak on climate action. But at COP26, we have seen, running up to it, a number of net zero carbon goals announced by UAE, Bahrain, Saudi Arabia, and then by India, which is very important, of course. We have seen some tangible progress on the agreement on deforestation. We've seen agreement on, with now 80 plus countries signed up to reduce methane leaks by 30% by the end of the decade. We've seen progress on climate financing. So, real progress in a whole set of areas.
Let's welcome Henning Gloystein, Director of Energy, Climate and Resources at the Eurasia Group. Henning, maybe just start out with your own thoughts on COP26. Do you share Robin's optimism?
Thank you, Sean. I do actually share Robin's optimism. So yeah, I mean, the disappointment, but that was expected, is that there's probably not going to be a globally unifying deal, and that's because the US and China can't really agree on anything at the moment. And of course, President Xi Jinping of China wasn't even at COP. He didn't bother to go, so they can't. China can't really do anything there. But because of that, the rest of the world felt a bit of an urge to do something. And Robin just mentioned, India did declare net zero target. For sure, it's 2070, which feels a bit like science fiction, but it does mean that the trend is there. Every emerging market in the world will feel the pressure to do something now. Indonesia has recently announced something as well. And very importantly, Vietnam, it's sort of everybody's darling for investment. It's the the quickest industrializing nation in the world. It's 100 million people, and they declared net zero 2050. Now, I'm not sure anyone, including Vietnam itself, knows how to get there that fast. But by just declaring it, it probably...
Is there a dartboard? Is there a dartboard where all these leaders, like, they've sit in their office, they go, there's 2030 in the middle, 2040, 2050, and they just kind of throw the dart, and then wherever it lands, the communications department writes a press release? I mean, do these actually mean anything?
Well, I mean, yeah, that's a sensitive point, because I do not think any leader or...
I mean, India 2070, India 2070. I mean, my goodness, it's like, it's so over the hill. It's hard.
Keep in mind, though, that Modi did also say a 50% renewable energy target by 2030. That's 8.5 years from now. So, so that's quite tangible. So
okay, we'll grasp that. I'm more interested in the tangible Delta outbreak that we're seeing in China, the most widespread since Wuhan. I know you've been a long time China watcher. Your thoughts on this latest outbreak? What can we trust from China's numbers? Henning, your thoughts?
Well, China has had a zero Delta tolerance policy since the start of the pandemic, and now they seem to have an outbreak that they can't push back to zero. It's across multiple provinces in China, and it's going to be a bit of a pickle for Beijing, because, I mean, do they lock the country down again, or do they let it rip like many other countries have had to accept, including, for instance, Singapore? It's a tiny country, but they've had a very similar policy, and they just have to accept the reality that this outbreak might not be controllable. So yeah, I think this is going to be complicated for China, because they had the policy of zero outbreaks, cases, and they can't keep that up at the moment.
Carol, coming back to our friends at the Fed, it seems to me to a great extent that inflation now is irrelevant. They've more or less sort of played us along on it, and the number, because 2% average on inflation, I still don't understand what that means. It basically means that any answer to any question, any time. But with the big number they seem to be obsessed with still is jobs. And your thoughts on the jobs reports coming tomorrow? Does that become a bigger direction as to where the potential for interest rates will go?
Sean, all along the Fed had two targets, which on the one hand you have inflation, on the other you have employment. So these are the two figures they are focusing on. For inflation...
But ultimately they changed the inflation target from 2% to 2% average, which in my opinion made it irrelevant.
Yes, but they also say that what you're seeing today in the market, the prices that you see, the inflationary pressures that you see today are related to supply chain bottlenecks that are expected to ease by maybe the second half of next year. So not really wages spiraling out of control. And that's why they are trying to tell us why this target that they are setting is not, cast in stone, and we should not really follow it religiously, because there are different drivers that are temporary of nature, and that's why they keep on using the term transitory. On the job market figures, we have to see what's going to happen tomorrow. They talk, it's not only about the employment figure, but also about active participation, and that would be interesting, something to watch for. I mean, look, at the end, if you look at the market's reaction, even though you may not have great confidence in what comes out of the Fed, but you can see that the market seems to be at ease with this kind of announcements. And that's why I mentioned earlier, they have a greater confidence at the moment. Everything might change overnight, right? We're still in very shaky conditions, and what's happening in China, we don't know how big it's going to have in terms of spillovers. In oil markets, things seem to be, looking in different ways. Iran, so there are lots of moving parts at the same time. But so far, the market reaction to the Fed's announcements seems to be that they have greater confidence in the policy going forward.
Robin, I think I welcome your thoughts on this subject. My sense would be the markets are reacting to the fact that Jay Powell, as long as he's in the seat, is going to leave the punch bowl at the party, and this thing's going to rip. An accommodative policy will be the central theme.
Yeah, that may well be, but it is getting a bit tricky. Obviously, there's always the question: how much do you look through the energy inflation as being transitory? But eventually transitory things become permanent, and we saw that in the 70s. Don't think we're going back to the 70s, but still, there should be the thought at the back of policymakers' minds. When you do have inflation, whether it's considered to be transitory or permanent, and ultra low interest rates, you're running a very accommodative monetary policy. So that is going to exacerbate all the supply chain bottlenecks and so on that we see. And eventually that also has impacts on slower growth, just these bottlenecks. The China thing, I think, is important because, partly because of the bottlenecks that we see. But of course, obviously, if there's a further lockdown, then that affects China's ability to supply even further. All of these supply chain bottlenecks, years of underinvestment, and then the shock of the pandemic, but then also trying to run a US economy and a global economy at a high temperature.
Robin, just to move on to the more immediate, as well, with the Iran news overnight that talks will reconvene on the 29th of November. Oil markets moving down on that news. Your thoughts on this announcement? Is it tangible?
I'm a bit surprised that the oil market reaction to the extent that indeed that was because of the Iran news. I don't expect much immediate to come out of these Iran talks. I mean, okay, fine, they're set to resume, but we've been down this road before. Getting these talks restarted, making any tangible progress has been very difficult, and I think Biden's domestic position that doesn't help that anymore at the moment. There was a window of opportunity to go back into the JCPOA as soon as Biden took office, and he didn't take that, and things subsequently got more and more difficult. So look, I think a comprehensive agreement to come back into the JCPOA is a long way off. Some kind of interim agreement, possibly, that would allow Iran to sell some more oil. And Iran's oil exports have been creeping up anyway. So some interim agreement, possibly. That could be something that puts pressure on the market if Iran could bring back a bit of oil. But I think comprehensive agreement is a long way off, and I wouldn't, if I was looking at the oil market, I wouldn't particularly worry about a lot of new supply from Iran.
Henning, your thoughts and what is the view on Eurasia on this? And as Robin mentions, I know Ian Bremmer has been fairly generous to Biden in the year and sort of allowing him to find his feet, but it just seems like he's getting weaker and weaker.
It's correct. Yes, I mean the Iran deal, or the lack of it, is a very good signal and sign of that. The interest by Biden initially this year was to find a deal with and some form of compromise with Iran to allow its oil back into the market. It's not happened. As Robin said, it's probably not going to happen this year. I mean, it's almost certainly not. And it's a bit of a weird situation because basically everybody wants the deal to happen. Iran wants it. Obviously, they want to sell more oil. America wants it because they want to focus on China and de-escalate the Middle East. But the problem is that nobody is willing or capable of giving the other side the compromise that the other side wants or needs to do a deal. And that is the problem. And I, at the moment, I agree with Robin. It doesn't seem imminent that there is such a compromise.
Carol, your thoughts if you want to weigh in on that, but also today is the OPEC meeting, OPEC Plus. They're digesting the Iran news as well, I'm sure. But perhaps with the reversal in the oil price heading back towards 80 on Brent, they're justified in their fairly conservative approach to releasing new supply.
Indeed, on the Iran thing, I agree with what Robin said. We're not going to expect any miracles happening overnight. We already have the previous trend with negotiations that didn't get anywhere. And if they do, they don't justify the kind of downward pressure. There's some kind of reaction, but it's not, in my opinion, that rational. For OPEC Plus, I mean, really, what we're seeing today with prices kind of confirm OPEC's position all along when they kept on reminding us that there are still significant uncertainties. Even the recovery in demand is not a fait accompli. It has not been, that's it, fully secured, because yes, you do have growth in some areas, but you also have risk emerging in other areas. And that's why I don't see a reason for them to move away from the agreement that they reached in July and putting 400,000 barrels a day in line is what they agreed. Also, when people talk about today the political pressure coming from the US and whether OPEC Plus would give in, well, that pressure, in my opinion, is not as strong. If you look at historically, the kind of pressure the US has put on OPEC, this is not really as strong, although it's becoming tougher, because for the US, of course, it makes sense to have the bad guy and blame the increase in prices on. And it's interesting that they started to use again the term cartel to describe OPEC, and that would really annoy some people within OPEC because they kind of hate that terminology. So we are seeing more tightening of the pressure, but we shouldn't forget also that prices where they are today actually benefit the US. I mean, of course, you have to weigh in between the consumer's impact and the producer's impact, but people tend to forget that in the current circumstances, the US still is the world's largest oil producer in the world, and higher prices benefit local production, leads to higher taxes paid to the government, leads to more employment, etc. So it's not as a dark, somber area that what you see, kind of get from the messages coming out of officials from Washington.
Robin, your thoughts and expectations on the OPEC Plus meeting? I mean, clearly there's a point there that Carol makes. The well-being of the U.S. energy industry is looking very robust now with significant earnings, but still unwilling to open the taps on shale.
Yes, I expect that, and I think this seems to be consensus, that OPEC will hold the course on its 400,000 barrel a day increases. I don't see any reason to change that. Oil prices is still fairly strong, but I think the recent slip will just mean that any idea that there may have been of a bigger increase will go away. Why would there be? Would there be a bigger increase? You have the prospect of Iran. We don't think that's very likely, but there is the prospect of Iran coming back. The tapering economic slowdown, so a slowdown in demand. I mean, put all these things together. I think OPEC will just.
What about Robin? At least addressing the fact that they're not even meeting the 400,000.
Well, that's the problem. That's what I was going to come to, Sean, because we know these 400,000 barrel a day increases are becoming increasingly cosmetic, because now, every time they increase, some other producer hits its ceiling. And, first of all, that was Angola and Nigeria, Algeria, now Kuwait is starting to max out. And pretty soon it'll be UAE and Saudi will be the only two that have any substantial room for increases. Now, at that point, do they keep saying 400,000 and actually delivering 200 or 100,000 increases? Or do they say, well, now we need to rethink and reset baselines again, or give a further increase, or something like that? But then, they had such an issue a few months back with the UAE's higher baseline. I think they'll be unwilling to reopen that argument until sometime into next year, because they have a view that next year is going to be tricky. Perhaps it won't be that tricky, but there is a view that we'll be back in surplus next year, and they don't want to. They want to go into that year with some spare powder.
Henning, they are meeting today, OPEC Plus, under the threat, it would appear, of a release from the SPR. Biden is signaling quite strongly that is on the cards. Should they be concerned by that, do you think?
No, I mean, those are short-term measures, of course. I mean, China has done the same thing. But I think OPEC will try, yes, or say that they will add supply. And as Robin just said, the main issue is that despite what they've said, they haven't really done that since August. And that's why prices are where they are. But OPEC does clearly seem a bit concerned about demand next year. So they don't want to flood the market to ease the spot market and then create problems for 2022 when the demand outlook really is a bit shaky still. So I reckon OPEC will probably hold the course and say yes, we'll add some barrels as we said, and then we'll see what reality actually produces. And I think that's what we need to look for, not what they say.
Let's go to the survey question and see that everybody have a view on this tapering stuff. Stocks, as in stock markets, rose after the Fed taper without the tantrum. That's the headline. Will the tantrum still come? Is my question. It's only day one. Will the tantrum still come in time as inflation still soaring? If the Fed doesn't tackle inflation head on, do we still get the tantrum because they'll have to be a lot more aggressive? Yes or no, will the tantrum still come because inflation is still soaring? Your thoughts on that question. Carol, one of the outcomes of the news overnight is a weakening dollar. If indeed we do see the UK central bank move on rates, the dollar could weaken further. Your thoughts on what the weakening dollar might mean for the oil market complex?
Yeah, it's a very complex relationship, and people have tried to, for a long time, to understand the relationship. I don't have really a strong view on that to confirm that there is an impact of the, let's say, US dollar on oil markets. It definitely has impact on the economies of oil exporters, particularly in the Gulf countries where the currency is pegged to the dollar. But whether the weak dollar or the strong dollar drives oil prices, as some would argue, I am quite suspicious in that respect.
It certainly has elements of easing the pain, if you like, Robin, on the emerging market economies who are buying all of their commodities in dollars. The news overnight, how is that likely to be digested, you think, in Asia, the demand center of oil, obviously, and other commodities?
Yeah, I think the dollar, this issue of the dollar and oil price, it has a short-term impact on temporary price moves. I don't see it having a longer-term impact. I think that's the best way to look at it. But I think that for me, I think the fundamental news will be more important. The
fact that the US, at least moderately, is moving towards a tightening cycle from the point of view of the emerging economies is technically, at least historically, bad news.
Yes, that I'm agreed on. Sure, I think that's more important than just the absolute level of the dollar. But the tightening cycle is clearly important. And do we get through this smoothly, or do we see a significant slowdown? I think that's the question, because we've seen obviously pretty strong rebound in demand from the pandemic, driven by this very accommodative monetary policy. But we are we're now kind of moving to the end of that, and we're seeing the consequences of that in terms of all these supply chain issues. Will this be a smooth landing? I mean, these things are already smooth landings.
Do you think that the Fed can continue to ignore the inflation and sort of rebrand or brand it as this temporary thing, as a blame it on the truck drivers who aren't showing up to work at the ports in LA or whatever Jay Powell is looking at?
I think you will see a lot of other constraints emerging in the economy. That's the nature of running a high pressure economy, right? Once you fix the truck drivers, it'll be something else. And usually that cycle only ends with some substantial rate rises and a slowdown in the economy while everything else catches up. I think we'll discover a lot of other weak points in the economy as things progress. You can point to plenty of other areas, and don't forget the bigger backdrop of this, all the green transition, and we talked about COP26 earlier. That is going to reveal a lot of other strains and stresses in that transition, a lot of other shortages. We talk about things like critical metals and so on, like copper. There's if we go all in on the green transition, there's a lot of other potential pain points in the economy that perhaps we haven't discovered yet.
Henning, do you think there is any outcome from COP26 which could have immediate downward pressure on oil prices? It seems somewhat of a disconnected event at the moment from the front month, from the immediate, but is there anything that could come out of there that could weigh in on this somewhat downward pressure we're seeing at the moment?
I think it's all about sentiment. I don't think COP will produce a result where the world suddenly realizes, oh, that's going to immediately result in a lower demand for oil barrels. That's almost certainly not going to happen. But oil markets are as much as they are about sentiment as they are about fundamentals almost. So if the sentiment comes out that that really this trajectory on a green transition is going to be there to last, which probably it is, maybe a little bit. But basically, no, I do not think COP26 is a significant oil price driver. The one thing.
What about on the other
just,
side of it? The other side being, and maybe that was the issue going into COP, was the idea that the discouraging investment in fossil fuels. Has that already been baked in the price, or could we get another layer of that, which brings an upward motion to price?
Well, so exactly. So I mean, I don't know whether it's COP26 as an event itself, but the green transition, industrial transition, which is almost certainly going to take place, will raise operational and capex costs throughout all supply chains, almost without a doubt. And that's what Robin was just hinting at. That will raise the cost for everything over the next few years, and it adds inflationary pressure to the world's economy. I'm quite certain of that.
Just a final comment, Henning, on China. Are we seeing a managed equation there, or do you have any sense that the authorities there are losing some of the sort of very tight vice grip they have on the society and the economy there?
Not sure about the society, but about the economy, there's certainly a little bit of uncertainty going on in China, because the Evergrande crisis, yes, it's just one company, but the problem is it's a big company. It's real estate and construction, which is one of the, maybe even the key driver of the Chinese economy. And there is a bit of a breakdown in trust. And that means that a lot of construction and real estate firms have a bit of a doubt to engage with their counterparties, because nobody knows how far this contagion of the real estate crisis goes in China. And breakdowns in trust for economies, as the West found out 12, 13 years ago, can be really dangerous. And we simply don't know how deep this goes in China. And I don't think the government in Beijing really knows that either. And that is.
We had some warnings of concern over the last few days by the outgoing chairman of the American Chamber of Commerce in China, talking about the amount of expats leaving China for all sorts of different reasons. Let's give Dr. Carroll the last word this morning with the survey result and the weekend ahead of us. Will the tantrum still come in time as inflation still soaring? Big view in this room, yes. Your thoughts on the outcome of that, Carol, and we're going into the Middle East weekend. Is there anything we should be watching?
First, Sean, as I listened to the conversations, and not only this one, but others, I had just have the feeling that we're looking at the future still following the old-fashioned conventional linear models. And we forget that the global economy has been hit by a crisis like no other. The ramifications of that crisis are yet to become more notable, and that will become clearer as time passes by, like next year, for instance. So this was something we call, and I love the path-dependent theory, so we may have a completely new outcomes that we haven't really envisaged. And one of the things that I realized that people focus on a lot is, when do we go back to pre-COVID levels, for example, for GDP in this country or the other or on a global level. But what seems to be missing is that, are we going to go back to reinstate the growth rates that we had once we hit the pre-COVID levels? So lots of moving parts, and therefore zooming in only on interest rates here or tapering there is, of course, important for the short-term changes in, let's say, stock markets and investment, etc. But we have to keep the bigger picture in perspective, that we might well see bigger scarring. Henning mentioned the limited decline in trust in China in the government. It's not only there, it's going to happening else everywhere. And with the increase in disparities between income inequality becoming more severe with higher energy prices in particular, this may have ramifications on many places, not only in China, but also elsewhere.
Well, I do think in some ways the inflation that we're seeing emerge, the fact that it is irrelevant from a policy point of view, in the sense that whether it's to ease the pain of the COVID pandemic or the 10 plus 20 years of mounting debt, in both cases they come together to indicate that I don't think the Fed can do much about inflation when it comes to rates. But there's real political consequence to that. We saw Joe Biden's party lose in Virginia yesterday. That's a huge, huge signal that the Democrats are up for a big loss year. And one of the major reasons driving that is inflation. So a lot to watch in that space. But we're going to wrap it up here today, this week, with oil prices declining in Asia this morning. We've Mike Muller up on Sunday with Christoph Ruhl to give us their sense of all of these issues that will set us up for the weeks ahead, the month ahead. Robin Mills, thank you so much for joining us. Henning as well. And Dr. Carroll, thank you for your thoughts and insights this Thursday morning. Have a great weekend, everybody, and we'll catch up Sunday morning with Mike Muller, Christoph Ruhl. All the best.